Alright, today is Tuesday, September 22nd, and this is a post-market review for the stock market activities today. We have a lot on the agenda today, specifically discussing the headlines. There's a story about the inflow, the historic outflow and inflow into the queues. We will go through that story and figure out whether we can find valuable information on the direction of the market. We are also doing charts of the SPY, the Q's, dollar index, the VIX, Apple, and Tesla. And of course, there's interesting action in the heat map and rotation trade analysis. In addition, of course, we do have Battery Day, which is going on right now as I'm recording this video. And of course, I have it on live stream on the other screen, and I have my Bible on one hand and my popcorn in the other, waiting for Reverend Elon to take center stage. But for now, we do have a market to cover, and here we go. The Dow Industrial Average closing in the green, 139.69 points, or an increase of 0.51%. The Nasdaq in the green, 184.84 points, or a gain of 1.71%. S&P 500 in the green as well, 34.51 points, or an increase of 1.05%. Switching to the sector's performance, the gold medal goes to consumer cyclicals, the silver, communication services, and the bronze goes to technology. The laggards of the day led by energy, financials, and healthcare. Energy, no relief inside here. And moving on to the futures market review. Looking at grains, the gainers, of course, the notable gainers are rough rice and oats. What about meats? You see lean hogs. We talked about lean hogs yesterday, that the dips in lean hogs are an opportunity to open contracts, due of course to the shortage of supply. And we see metals, of course, copper shining in metals. However, palladium taking it on the chin just a little bit. And when it comes to softs, you see coffee, OJ, coca declining, specifically coca declining a lot today, yet sugar and lumber in the green. And speaking of lumber, the prices of lumber have declined almost 50% from the peak. Futures contracts in upcoming months indicate lower prices for lumber. So why are the morons rushing and stampeding to buy homes? Since this crisis happened, the dummy consumer went Naruto style, buying homes, the most expensive and the longest financial commitment in our lives. It shows how naive these people are, pushing housing prices higher to unattainable prices. And of course, their argument is that mortgage rates are low. Mortgage rates are going to continue to get lower because the Fed has a commitment of not increasing rates for the next 3 years. So why the rush? And what is the point of having a low mortgage, yet you're overpaying for the house in the first place? Patience is a virtue, and those who've been patient will be rewarded. Prices of lumber will go down, the supply of houses will go up, mortgage rates will continue to decline, prices will decline as a factor, and you will have a golden opportunity at buying homes. You just gotta be patient. Let the sheep morons stampede first, and there will be plenty of homes for you to buy at cheaper prices and better mortgage rates. And by the way, making the biggest financial commitment in your life in one of the most uncertain times in our lives during this pandemic, when you're not certain that you're going to keep your job next year, or if you're going to be in the same geographical area next year due to the work from home culture. Why make that commitment now? Never underestimate the stupidity of humanity. And of course, moving on to the big casino, the options market. The tables are muted. They haven't been hot lately, yet there are notable trades to cover. Leading the pack at number 1, Apple, with 1.8 million options traded today. 72% of those were calls. At number 2, Tesla, 800,000 options traded today. 67% of those were calls. At number 3, climbing back up after being ignored for weeks now, Facebook, 380,000 options traded today. Again, not a significant amount, but yet it comes to number 3 with 77.5% of those options traded today for calls. We're seeing the numbers shifting higher, more bets on calls, but I have a theory here that a lot of the Robin Hoodians who've been gambling on options last month have been already shaken out of the market and lost their money, because you'd expect them to stampede since the market had a big green day yesterday and another one today. We'll see if the Robin Hoodians are going to make a comeback or whether they got a really hard punch from the decline we saw in the market recently, and most of them were shaken off the market. That remains to be seen. And looking at the volume leaders today, you can see Apple per usual. The most interesting trades going on here, whether it's Apple or Facebook or Boeing, it is for the next round number higher. They're buying the call strikes expiring this week. In the case of Apple, of course, it is the 115 call. So if you're playing the micro picture and you're chasing the rebound, this is a trade you might be interested in. But what caught my attention, of course, is Peloton, specifically the trade for January 2021. The trade says that Peloton will drop all the way to $30 a share. They're buying the 30 put expiring in January 2021. You've heard the news, of course, that Amazon is coming up with a bike. This was a no-brainer. It is an industry that would be easily disrupted, and the barrier of entry is very, very low. Furthermore, the valuation of Peloton is out of whack. It is valued more than Ford. Peloton barely makes a few $100 million in revenue. Ford makes over $100 billion in revenues every year. Now, I understand growth versus old school company. I am a financial analyst and I worked for some of the largest corporations before. I know how to do valuations, and you have to factor premiums for growth. Yet there is no valuation model in the world that would be acceptable to value Peloton at $27 billion. And of course, I do have a short position in Peloton. Moving on to the headlines that shaped the day. Starting with the most important story of the day from Bloomberg, covering the insane action in the Qs, specifically in the options market. You are aware that this market has turned into a casino, a gambling market, where the Robin Hoodians and the likes from the retail side are stampeding to buy options. They discovered the options world. And in their mind, the options world is a poor man's way to become rich. And it is a quick and easy way to make money and not look for a job anymore. They've been proven right for a few months, buying call on blindfold, and this strategy worked for them for a little bit. Some traders managed to turn 1,000 into 10,000 to 100,000, but of course, they got a surprise in September, and a lot of them lost all of their quote-unquote gains. Welcome to the options market. There is no easy way to get rich. But the story goes that we have seen over 10 million contracts in the Qs alone. We're talking about last Friday. This is the highest volume of options traded in the Qs since 2007. Furthermore, the outflow and inflow is the largest in 20 years, meaning since the dot-com crash. Quadruple witching had the highest amount of outflow from the Qs. About $3.48 billion exited the Qs on Friday. And what do you know? Yesterday, Monday of this week, we have seen the largest inflow back in the Qs. About $4.16 billion found its way back to the Qs. This is the pump and dump done via the options market. And of course, the Bloomberg article says that at least $3 billion of the $3.48 billion outflow from the Qs on Friday were tied directly to options. Another proof that we are in a casino. And we are seeing the highest open interest in the NASDAQ and the technology names since 2008, indicating that a lot of the gamblers are already all in. Very, very dangerous market to be in right now. Now, here's a statement that I disagree with. The genius they interviewed for this article said that the record inflow that we've seen in the queues on Monday was investors resetting the value of the queues and they're following the 21st century technology trade, blah, blah, blah. We're already in the 21st century. We're already 2 decades in the 21st century. This guy's talking as if we were in 1999. I don't see the inflow as investors all of a sudden figuring out, oh, there is value in technology now. After we just dropped 10%, now all of a sudden the queues are cheap. Bullshit. And they keep referring to them as investors, quote unquote investors. There are no investors in the market anymore. It is gambling. It is the Robin Hood idiots and the maniacs chasing the market, making impulsive moves up and down. Now the question is, was this a one-time shakeout operation for market leaders, aka option riders, to shake out the Robin Hoodies at the market, and now they're flowing the money back to the queues and they're gonna ride another ride higher? Certainly possible. We don't have the data, but I do believe that this is another pump and dump in the making. During quadruple witching, they managed to dump a lot of shares to make sure that all the calls are expiring worthless, and now they're using the proceeds to create another pump and dump. That is at least my 2 cents. Moving on to another story, the Federal Reserve. Of course, the Fed, Jerome Powell is speaking. He was speaking today with Slimy Mnuchin, and a lot of Fed personalities been speaking this week. So far, more to come. However, not all of them got the same memo. Case in point, Bullard, Jim Bullard of the St. Louis Fed. We talked about Bullard before. Bullard is doing a significant amount of hash and weed and who knows what else. And he is in a world of his own right now. He's imagining that we will have a GDP growth that exceeds 35% and the recession lasted for 2 months and it's already over and things are just rosy and world peace and love and let's roll another joint. And of course, Bullard forgot the memo from Jerome, and he went on television and he said that the Fed has already done enough aid. Jim, you're not supposed to say that. Don't freak out the market. You're supposed to say we will do whatever, whenever, however the market needs us to do. There are no limits. We are flexible and we are quote unquote powerful. Don't forget that one. But of course, Bullard slipped. And speaking of slipping, here is another one, Evans of the Chicago Fed. He also slipped today and he said that the Fed actually can hike up rates if inflation rises above the 2% target. Remember, Jerome said we're not going to play with rates all the way to 2023. You guys are safe. Go back to buying stocks. And now Evans comes out and say, oh, you know what? We might actually hike the rates if inflation goes higher against Jerome's wishes. Now, the Fed playing with interest rates, opening the tap, closing the tap to control inflation is a very dangerous strategy because the market is a coke addict. And when I say coke addict, the coke is the Fed's liquidity and low interest rates. And if you're going to hike rates to control inflation, the market will suffer a withdrawal and it will need the Fed to stop and continue the flow of coke back to the market. Case in point, in 2018, remember when the Fed increased rates and Jerome talked about the autopilot policy to control inflation, the market suffered a withdrawal and we saw one of the largest and the sharpest drops in a short amount of time. And once Jerome came back and said, okay, all right, no hikes, I'm going to continue to supply the coke to the market, go back to buying stocks. Guess what? We went back to buying stocks and the market reversed and rallied from there. This is not going to happen anymore if the Fed is going to play with interest rates and allow inflation to rise above 2% and use the 2% parameter as an average. Very dangerous game. All the morons who keep saying buy stocks because the Fed is on our side, be careful what you wish for. Moving on to some picture on the macro economy. We are, of course, witnessing the conflict between landlords and small business. Small business managed to extend and get some forgiveness from landlords, but sooner or later, landlords want to collect the outstanding rent from small business. Absence a new round of PPP loans, small business will have to suffer permanent closures because they cannot keep up with paying landlords. They will get sued, they will have to declare bankruptcy, and that's that. Furthermore, the worry about the COVID crisis is shifting from being a health crisis into an economic crisis. At least this is the opinion of US households. They're saying that the impact of COVID, the economic impact of COVID, is now becoming as worrisome, if not more, as the health impact of COVID on our society. Of course, it doesn't help when a CEO like Tim Apple comes out and says, hey, some of that work from home culture and changes will become permanent. And we see retailers like Ralph Lauren saying that they will close a lot of stores and they will shift to an online strategy. All these retail jobs are now gone. And you see the US households are now worrying more about the economic impact of COVID compared to the health impact of COVID. One can be controlled by wearing masks, treatments, and vaccines. The other one, the economic impact, the scars from the COVID economic crisis will remain for years and years to come. There is no easy fix here. And of course, the last segment we're doing for the headlines today is a segment called Bullshit Headlines. An example, of course, here is a report saying that US household net worth surged significantly to pre-pandemic levels. Now, if you put me and Jeff Bezos in one group and you compare our net worth together pre and post-pandemic, we are a lot richer. Take Jeff Bezos out of that group and the picture will be a lot different. This is the kind of bullshit that the media repeats and parrots without any critical thinking whatsoever. Another case, of course, we have Chase Bank saying that credit card spending is solid and increased significantly. Of course, when you lump all of us together and the majority of people, as I showed you from previous reports and research, are not using their credit cards, then who is using credit cards? The rich and the haves. They're spending. It is open season for them. The pandemic is the best thing that ever happened to that group. Is it really a surprise that they're using their credit cards more? That doesn't mean that the average Joe and Jane are spending as well. Or maybe it is the mobsters and the drug lords that Jamie Dimon of Chase Bank has been caught washing money for, according to the FinCEN revelations that we've heard yesterday. Chase Bank washing money for mobsters, Russian oligarchs, drug lords, and who knows what else. So if you have some dirty money, you need it to be washed, give a call to Jamie Dimon. He'll wash it for you for a small fee. The folding service, of course, that is sold separately. Moving on to the heat map analysis, and as you can see, big tech green. The big boxes of big tech are on. However, interestingly enough, consumer defensives, the majority of those names in the green. Industrials in the green. Consumer cyclicals, a lot of names in the green. Now, forget about financials and energy. The woes of financials and energy are unique and different to those industries. But you see a lot of the reopening names performed well hand in hand with technology. What's going on here? I thought we are a bipolar market. We shift to one trade one day and then again to the other. So let's look under the hood and see what's going on. Shifting to the rotation trade. As you can see, the tug of war that started this week. Which side of the aisle will be proven right? Is it the crowd that said, hey, COVID is coming back, let's go back to momentum names / stay-at-home names, Apple, Zoom, Nvidia, and the rest of them? Or is it the crowd that've been rotating out of these sectors to the comeback stocks for the last few weeks? This is the battle of this week. Which side will be proven right? Because we know the two sides of the aisle can't rally together. That would be insanity, given, of course, that it is the year 2020. My estimate is Monday could have been a knee-jerk reaction, shifting back to technology and momentum stocks. And that trade, of course, got ignited and caught a bit again today. And the knee-jerk reaction on Monday was sell everything in the reopening stocks. You saw them getting hammered significantly yesterday. Today, the picture is quite different. They managed to come back. Some names suffered very minimal losses, but others managed to close in the green. So the question is, are we going to see by the end of the week the rotation of the rotation of the rotation? Certainly, possible. We're keep an eye on that. And that, of course, could coincide with certain resistance levels in the cues. Speaking of resistance levels, let's shift now to the charts analysis. Starting with the S&P 500, the SPY. From a daily perspective, nothing changed. The 20 days moving average is the target here for the rebound. Surpassing the 20 days moving average, we have to reassess and give the market the benefit of the doubt that this rally has more legs than we thought. Doubtful for now, but everything is possible. Looking under the hood for a 15 minutes perspective, as you can see, the SPY closed right at the gap, keeping everybody on edge. What is going to happen tomorrow? Surpassing the gap, closing higher, would be very bullish for the SPY, and it would say that there is more leg to this rally, and the 20 days moving average will be the next target. Reversing after reaching the gap is very negative. So if you wake up in the morning tomorrow and you see the SPY gapping down, that would be extremely negative and it would trigger a shorting and a sell signal. Likewise, moving to the cues, the Nasdaq, a daily perspective. You see that we are marching to the trend as we talked about yesterday, and we do have a gap. We will look at it in the 15 minutes look. But as you can see, if you are following the micro trade of the rebound, you know exactly what to do. Your target is the trend line, and you will buy Apple, you will buy Nvidia, you will buy the TQQQs. You know the deal. Me, I'm a macro type of trader. Speaking of macro, let's look at the 15 minutes chart under the hood. You see that the Qs did not reach the gap yet, but it is marching toward that goalpost. Reversing before reaching the gap or reaching the gap and then failing to close above it would be very negative and would signal a reversal of this rebound. So you got to keep your eyes on that gap. Switching to the dollar index. The dollar, another day, another rally. As expected, we have anticipated this move in the dollar, and the dollar could be a leading indicator telling you that the rebound in the market isn't sustainable. When you look at a weekly chart of the dollar index, specifically the MACD, we just started making green impressions, meaning that there is more leg for the rally in the dollar. Moving on to the chart of the VIX, as you can see, the VIX gapping higher, giving it back again. It's the same story day after day. And it looks like the VIX is trying to stall and dive lower all the way back to the support line and then perhaps catch the support and rally again. That would coincide with a decline and a sell-off in the SPY. Here is a chart of Apple, a daily chart. You can see that the destination right now is the 20 days moving average. That is the goal. That is the target for now. However, we are at a resistance line. And if this resistance hold and you see Apple reversing tomorrow, that is your leading indicator that we will see more pain in the Qs. Remember, Apple was the leading indicator yesterday, rallying, and you saw the Qs following Apple's lead. Apple's goes down tomorrow, fails to break the resistance, would be a signal for the Qs to sell off. Tesla, what's going on in Tesla? We've peaked above the higher limit of the wedge, but we've reversed and we've came back. That is very negative behavior. But remember, battery day is going on as I'm speaking right now, and it is all about battery day. If battery day excites the crowd, you could see a big day in Tesla. We know that the 500, the 450, and all the way to the 600 calls have enormous open interest right now, meaning that a gamma squeeze is on the table, but that is a very weak possibility. The possibility I see is a sell-off and an opportunity for bears, Tesla bears, to finally strike back and short the name, driving it lower, and all these 450 and above calls will expire worthless. Again, all dependent, of course, on battery day and what Reverend Elon Musk would say. And now let's conclude this video. We saw Monday the knee-jerk reaction due to the COVID news in Britain, selling off the airlines, selling off hotels, selling off casinos, selling off cruises, and we reverted back to technology and momentum names. Yet the problem in technology and momentum names remains the same. Nothing has changed. The valuations are too high. They will not be able to live to these valuations when the third quarter earnings are finally revealed. Institutional investors know that, and they will dump accordingly. Furthermore, you know the news that we've uncovered on the Qs from Bloomberg. Option riders managed to create a massive pump and dump in the late part of August, early September, and it looks like they're trying to do it again. In addition, of course, we saw rebound, small one granted, in the reopening names, the airlines, hotels, casinos, cruises. That still doesn't give me a green light and a signal to go back and accumulate in the reopening names. All I did yesterday is I sold a bunch of puts. If they hit, I will reassess whether I'm going to exercise these puts and buy shares. And if that doesn't happen, I will get to collect the cash. This is the strategy for now. Today was a no trading day for me. I did nothing and I'm just staying in the sidelines with a big bag of popcorn in my hands, watching the show. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.